Two people invest in crypto. One quietly builds wealth, the other loses everything and still tells everyone he's early. Same market, same coins, completely different outcomes. The difference isn't luck. It's something darker hiding beneath crypto that almost nobody talks about, until it's too late. If you've ever thought crypto is your shortcut to financial freedom, you need to see this. And if you want deeper insights, real strategies, and even more absurd money truths, join our Telegram channel, link in the description. Let me tell you a story that doesn't show up on YouTube thumbnails. No Lambos, no screenshots of 10 times gains, just reality. Two friends, Alex and Mark, same age, same income, same curiosity about crypto. They both got in around the same time, same excitement, same belief that this was their way out. But fast forward 3 years, Alex has built a portfolio worth around $180,000. Nothing crazy, no viral success, just steady, boring growth. Mark had moments where his account showed $220,000, and today he's sitting at $14,000. And the worst part? Mark still believes he just got unlucky. Think about that. Because this is where the dark side of crypto begins. It's not the volatility, it's not the scams, it's not even the crashes, it's the illusion. Crypto doesn't just move your money, it rewires how you think about money. And once that shift happens, most people never notice it. At first, it feels like empowerment. You're no longer just saving slowly, you're participating in something explosive. You check your portfolio more often, you start learning terms, you feel ahead of the curve. And that's where it hooks you, because the market doesn't reward knowledge early on. It rewards timing, and timing feels like intelligence. Mark bought his first coin and it doubled in 2 weeks. No research, no strategy, just luck. But his brain didn't register it as luck. It registered it as skill. That's the first trap. Early wins in crypto are dangerous. Not because they make you money, but because they convince you that making money is easy. Alex had the opposite start. His first investment dropped 30%, immediately, and instead of doubling down emotionally, he stepped back. He started asking questions. What am I actually investing in? Why does this exist? Who benefits if this succeeds? Mark didn't ask those questions. Mark asked a different one. What's the next coin that can do this again? And that single difference created two completely different financial futures. Because crypto, at its core, is not just an investment space, it's a psychological amplifier. Whatever habits you already have with money, it multiplies them. If you're patient, it rewards you slowly. If you're impulsive, it accelerates your losses. And most people don't realize which one they are until it's too late. Here's something nobody tells you. The majority of crypto profits are made by a very small group of people. And it's not who you think. It's not just early adopters. It's not just developers. It's the people who understand liquidity. Every time you buy into hype, someone is selling into it. Every time you feel like you're catching the wave, you might actually be the exit strategy. Think about that. When a coin is trending on Twitter, YouTube, Reddit, it's not early anymore. It feels early. But psychologically, it's already crowded. And markets punish crowds. Mark didn't see that. He saw momentum. He saw opportunity. He saw other people making money. And his brain translated that into urgency. If I don't act now, I'll miss it. That's not investing. That's fear of missing out dressed up as strategy. Alex felt it too. Of course he did. Everyone does. But he treated that feeling as a warning, not a signal. That's the difference. Because the dark side of crypto isn't just about losing money. It's about how easily it convinces you to abandon logic. You start justifying decisions you'd never make anywhere else. You wouldn't put your entire savings into a random startup with no revenue, no product, and anonymous founders. But in crypto, that happens every day, and it feels normal. That's the normalization effect. When everyone around you is doing something risky, it stops feeling risky. It starts feeling standard. Mark joined Discord groups, Telegram chats, Twitter spaces. Everyone was talking about the next big thing. Everyone sounded confident. Everyone had charts, predictions, narratives, and slowly his baseline shifted. What used to feel like gambling now felt like participation. Meanwhile, Alex simplified everything. He asked one question before every move. If this goes to zero, will I regret this decision? Not emotionally. logically. And that question protected him from most of the damage. Because here's the truth about crypto that nobody likes to admit. A huge percentage of projects will eventually go to zero, not because they're scams, but because attention moves, technology evolves, narratives shift, and in crypto, attention is everything. It's not just about what works, it's about what people believe works, right now. Mark didn't understand that. He thought holding longer meant being smarter, but in many cases, it just meant holding on to something that the market had already abandoned. And this is where things get even darker, because crypto doesn't just take your money slowly, it gives you hope while it's doing it. Your portfolio drops 40%, but you remember when it was up 200%, so you hold. It drops another 30%, but you tell yourself it will bounce, because it has before. And that's the trap. Hope becomes your strategy. Not data, not logic, not risk management, just hope. And hope is incredibly expensive in financial markets. Alex didn't rely on hope. He relied on rules, boring rules, the kind nobody wants to hear. He never put more than a certain percentage into a single asset. He took profits even when it felt early. He didn't chase pumps. And most importantly, he accepted that he would miss opportunities. That's a hard one, because crypto constantly makes you feel like you're one decision away from life-changing money. And technically, you are. But the same is true in reverse. One decision away from wiping out months or years of progress. The math doesn't lie. If you lose 50% of your portfolio, you need a 100% gain just to break even. And crypto makes those losses feel normal, casual, temporary, until they're not. Mark learned that the hard way. But even now, he doesn't fully see it, because the system is designed to keep you in the game. New coins, new narratives, new opportunities. It never ends. And that's the real dark side. Not that you can lose money, but that you can keep losing it, while believing you're about to win it all back. And here's where the story takes a turn that most people never talk about. Because losing money isn't actually what destroys people in crypto. It's what happens after they lose it. Mark didn't just lose money, he changed his behavior completely. At first, he was cautious. He'd put in $500, maybe $1,000. But after his early wins, those numbers stopped feeling significant. That's another hidden shift. Your baseline moves. What once felt risky now feels small. So when Mark's portfolio dropped from $220,000 to $140,000, he didn't slow down. He doubled down. Because in his mind, he wasn't risking money anymore. He was recovering losses. And that mindset is lethal. Because once you switch from building wealth to chasing losses, your decision-making changes completely. You stop asking, is this a good investment? And start asking, can this get me back to where I was? Those are two very different questions. One is rational, the other is emotional. And markets punish emotional decisions fast. Mark started taking bigger bets, smaller coins, higher volatility, projects he didn't understand. But they had one thing in common: potential. 10 times potential, 50 times potential. Life-changing potential. And that word, potential, is incredibly dangerous, because potential doesn't mean probability. Just because something can go up 10 times doesn't mean it likely will. In fact, the higher the potential return, the lower the probability of success. But your brain doesn't process it that way. It focuses on the upside, the story, the dream. Let me give you a simple example. Imagine I offer you two bets. First one, 80% chance to make $1,000. Second one, 5% chance to make $20,000. Most people intellectually know the first one is better, but emotionally, the second one feels more exciting, more meaningful, more worth it. That's exactly how crypto markets are structured. They constantly present you with asymmetric bets that look attractive, but are statistically brutal. And Mark kept choosing the second option, over and over again, because he wasn't just investing anymore. He was trying to feel something: excitement, hope, redemption. And this is where crypto becomes addictive, not chemically, psychologically, because every trade carries the possibility of changing your life. And your brain loves that. It's the same mechanism behind gambling: variable rewards. You don't know when the win will come, but you know it could come anytime. So you keep playing, you keep checking, you keep refreshing your portfolio like it's going to magically fix itself. And platforms are designed to feed that behavior. Bright charts, instant updates, notifications, everything is optimized to keep you engaged. Because the more you engage, the more you trade. And the more you trade, the more mistakes you make. Alex noticed this early, not in some dramatic way, just small things. He realized he was checking prices multiple times a day. He noticed how his mood changed depending on the market. Up 10%, he felt smart. Down 10%, he felt anxious. And that scared him, because he understood something most people ignore. If your emotions are tied to your investments, you're no longer in control. So he made a simple decision. He reduced exposure to noise. Less Twitter, less YouTube hype, fewer opinions, more focus. And that created distance. Distance between him and the chaos of the market. Mark did the opposite. He went deeper. More groups, more influencers, more signals. And here's the irony. The more information he consumed, the worse his decisions became. Because not all information is useful. In fact, most of it is just noise disguised as insight. Everyone sounds confident in crypto. Everyone has a narrative. Everyone explains why something is about to explode. But confidence is not accuracy, and narratives are not reality. Mark followed a guy on Twitter who called 3 successful trades in a row. The guy seemed like a genius. Charts, threads, thousands of likes. So Mark started copying his trades, and for a while, it worked. But then one trade went wrong, then another, and another. And suddenly, Mark wasn't just losing money, he was confused. Because the strategy that worked before stopped working. And that's another dark side of crypto. Strategies don't last. What works in one cycle often fails in the next. Because the market evolves. Participants change, liquidity shifts. But people don't adapt fast enough. They keep using old maps in a new environment, and they get lost. Alex didn't rely on other people's predictions. He built simple frameworks. If something doubled quickly, he took some profit. If he didn't understand it, he didn't buy it. If everyone was talking about it, he was cautious. Simple rules, not perfect, but consistent. And consistency is underrated. Because in crypto, people are always chasing the perfect move, the perfect entry, the perfect coin. But wealth isn't built on perfect decisions. It's built on avoiding catastrophic ones. And Mark made a few catastrophic ones. One project he invested $25,000 into disappeared. Not overnight, slowly. Liquidity dried up. The community faded. The developers stopped updating. Price kept dropping. And he kept holding. Because selling meant accepting the loss. And accepting the loss meant admitting he was wrong. And that's one of the hardest things for people to do with money. Admit they were wrong. So instead, they wait. They hope. They rationalize. It'll come back. The market is just down. It's undervalued. But deep down, they know. And the longer they wait, the harder it becomes to act. Because now it's not just about money. It's about identity. Nobody wants to feel like they got played. And crypto has a way of making smart people feel stupid. Very slowly, not all at once. Just small mistakes, repeated, compounded, until one day you look at your portfolio and think, what happened? And the answer isn't one bad decision. It's a pattern, a series of choices driven by emotion, not strategy. And the scariest part? It doesn't feel like you're making bad decisions while you're making them. It feels logical. It feels justified. It feels like you're one move away from fixing everything. But that move almost never comes. Because the game isn't designed for most people to win. It's designed for most people to participate. And at some point, something shifts. Not in the market, in you. Mark started noticing it in small ways first. He wasn't excited anymore. Even when a trade went up, it didn't feel like a win. It felt like relief, like he was finally breathing again after being underwater. That's a dangerous place to be. Because when profit feels like relief instead of progress, you're not building wealth anymore. You're just trying to escape pressure, and pressure makes people do strange things with money. Mark began checking his portfolio the moment he woke up. Not even getting out of bed first, just reaching for his phone, opening the app, scanning numbers like they could tell him something about his future. And if the numbers were red, the entire day felt off. You ever notice how quickly money can hijack your mood? One number on a screen, And suddenly your confidence drops, your focus disappears, your patience gets shorter. That's not investing anymore. That's emotional dependency. And crypto accelerates it because everything moves so fast. Stocks might take months to shift. Crypto can change your entire net worth in a week. That kind of speed rewires your expectations. Slow growth starts to feel boring, even pointless. Mark actually said this once. What's the point of making 8% a year when I've seen 200% in a month? And that's the trap right there. Exposure to extreme outcomes distorts your perception of normal returns. Suddenly, reasonable feels inadequate. And once that happens, you're in trouble. Because now you're chasing unrealistic benchmarks. Alex never fell into that. Not because he's smarter, but because he defined his game differently. He wasn't trying to get rich fast. He was trying to not get poor slowly. Subtle difference, but it changes everything. While Mark was trying to recover losses quickly, Alex was focused on protecting gains consistently. And protection doesn't feel exciting. There's no adrenaline in selling something early. There's no story in missing a 5 times because you took profits at 2 times. But over time, that discipline compounds. Mark, on the other hand, kept waiting for the big one, the trade that would fix everything, the one that would put him back on track. And ironically, he got close a few times. One coin he bought at 3 cents went to 11 cents. That's almost 4 times. His portfolio jumped significantly. For a moment, he was back. But he didn't sell, because now the narrative in his head was bigger. If it did 4 times, it can do 10 times. And just like that, the goalpost moved again. That coin eventually dropped back to 2 cents, lower than where he bought it. And what's crazy is, that pattern repeated multiple times. Gains that could have changed his trajectory turned into losses because they didn't feel like enough. That's another dark truth about crypto. It doesn't just make you greedy, it makes you blind to progress. Because when you're surrounded by stories of people making insane returns, your own wins start to feel small, irrelevant, even disappointing. Imagine making $20,000 and feeling like you failed. That sounds insane, until you've been in crypto long enough. Alex experienced the same market, same opportunities, same volatility. But his internal scoreboard was different. He measured success by consistency, not magnitude. A 30% gain mattered, a preserved profit mattered, avoiding a bad trade mattered, and those small wins added up, quietly, without drama. Meanwhile, Mark's journey became louder, but emptier. More trades, more stress, more stories, less actual progress. And here's where things get really uncomfortable. Because at some point, Mark realized something he didn't want to admit. He wasn't investing anymore. He was performing, posting about trades, talking about strategies, sharing opinions. Not because it helped his results, but because it helped his identity. He needed to feel like he knew what he was doing, even when the results said otherwise. And social media amplifies this. Everyone looks like a winner. Screenshots of profits, confident takes, big predictions. Nobody posts their losses in real time. Nobody says, "I just made a terrible decision." So you start believing that everyone else has figured it out, and you're just one step behind. That belief pushes you to take more risks, to prove something, to catch up. But there's nothing to catch up to, because most of what you're seeing isn't real, or at least not complete. Alex understood that early. He treated social media like entertainment, not education. Because real investing is boring. It doesn't look good in screenshots. It doesn't trend. It doesn't go viral. But it works. And that's the difference most people miss. Crypto rewards discipline, but it markets excitement. And most people follow the marketing, not the reality. Mark followed the excitement, and it cost him, not all at once, not in one big mistake, but in hundreds of small ones. And the hardest part? He kept thinking the next decision would fix everything. But wealth doesn't work like that. It's not built in moments, it's built in patterns. And if your pattern is broken, no single win can save you. Only changing the pattern can. And that's the part nobody wants to hear. And eventually, reality catches up. Not in a dramatic crash, not in some cinematic moment where everything disappears overnight. It's quieter than that. Mark woke up one morning, opened his portfolio like always, and for the first time, he didn't feel panic. He didn't feel hope either. Just emptiness. The numbers were there, smaller than before, but not shocking anymore, just familiar. And that's when it hits you. Not when you lose the money, but when you get used to losing it. That's the real bottom for most people. Not financial, psychological. Because once losing becomes normal, your standards collapse. You stop expecting growth. You stop expecting discipline. You just exist inside the cycle. Trade, lose, hope, repeat. And the dangerous part? You can stay there for years. Mark did. Small deposits here and there. Trying again. New narratives, new coins, same outcome. Not catastrophic losses anymore. Just slow erosion. Like a leak you never fix. And over time, it adds up. Not just financially, mentally. Because deep down, you start questioning yourself. Am I just bad at this? Why does everyone else seem to get it? What am I missing? And those questions are heavy, because they don't have simple answers. But here's the truth most people never hear. It's not that Mark was stupid. It's that he was playing a game he didn't understand, with rules nobody explained. Crypto isn't just about technology or investing. It's a system built on incentives, and those incentives aren't aligned with you. Platforms want you trading. Influencers want your attention. Projects want your liquidity. Nobody is rewarded for you sitting still and making rational decisions. In fact, that's the one thing the system quietly discourages. Think about it. The best financial move in many cases is to do nothing. Hold quality assets. Ignore noise. Wait. But that doesn't generate clicks. It doesn't create excitement. It doesn't keep you engaged. So instead, you're constantly pushed toward action. New opportunity, new narrative, new chance. And over time, you start believing that action equals progress. But in markets, activity is often the enemy of returns. Alex understood that. He didn't win because he found better coins. He won because he made fewer bad decisions. That's it. No secret strategy, no insider knowledge, just fewer mistakes. And that sounds simple until you realize how hard that is in an environment designed to make you act. Every notification, every price move, every headline, it's all trying to pull you into the game. And the more you play, the more likely you are to lose, because the odds aren't in your favor, not consistently, not long-term. So Alex changed the game entirely. He stopped treating crypto like a casino and started treating it like a small part of a bigger system. He limited exposure, set clear rules, defined exit points before entering, and most importantly, he accepted uncertainty. He didn't need to catch every opportunity. He didn't need to maximize every gain. He just needed to stay in the game long enough for good decisions to compound, and that's the part nobody wants to hear. Because it's not exciting. It doesn't promise fast results. It doesn't make for viral content. But it works. Slowly, quietly, consistently. Meanwhile, Mark kept looking for the moment that would change everything. The trade, the coin, the timing. But that moment doesn't exist. Not reliably, not sustainably. Wealth isn't built on moments. It's built on behavior, repeated over time. And if your behavior is driven by emotion, the outcome is predictable. Not immediately, but eventually. And here's the hardest truth in all of this. Crypto didn't ruin Mark. It revealed him. It amplified tendencies that were already there. Impulsiveness, need for validation, discomfort with slow progress. And that's why this matters beyond crypto. Because the same patterns show up everywhere. Stocks, business, career decisions. Money just makes them visible faster, more intense, more obvious. So if you take anything from this, let it be this. The biggest risk in crypto isn't volatility. It's not scams. It's not even bad projects. It's you, operating without awareness, making decisions based on emotion, not structure, chasing outcomes instead of building systems. Because once you fix that, everything changes. Not overnight, not dramatically, but steadily. And that's how real wealth is built. Not in spikes, in patterns, quiet ones, that most people ignore because they're too busy looking for something louder.